Good day, sir. My name is NehaSurwade, and in this IP video submission, I will be talking about how is credit controlled in India. How does the monetary policy work around it? And I will be talking about one case study, the NBFC non-banking financial crisis, and the way we can go around it, especially in Indian economy. So to start with, I will be talking about what exactly is, the first part would be talking about what exactly is the meaning of, credit control, and then I'll be talking about what are the objectives of credit control. Then I'll talk about, the third part would be about what are the ways in which credit is controlled, and fourth and final would be the NBFC financial crisis and the repercussions on the Indian GDP. So to start with, credit control is exactly what the name suggests, control of credit. So what happens is that in every country credit needs to be controlled. It needs to be controlled by it is controlled by the central bank. So obviously in India there's the RBI. So the objectives, the reasons why RBI controls credit is that for promotion of economic growth. So it's like especially in India where there are clusters of poverty, underdevelopment, unemployment. So there is lack of resources everywhere, or there's something called as Brahmin Bank, for example, which was started in Bangladesh. So in order to provide credit, to these sections of the society, credit, there needs to be a credit in the society, or for stabilizing the money market, or for stabilizing the exchange rate, or for stabilizing the internal price levels. So especially I want to elaborate on internal price levels. So what happens is that at times in because of credit, certain people get money in their hands, suddenly their purchasing power increases. So this can have adverse effect on some goods and services. So in order to keep check of the goods and services, and in order to keep the smooth flowing of supply and demand of money, RBI has to control the credit. And another objective that I can think of is preparing for war and emergencies. So these were the objectives. So coming on to next section, that is what are the ways in which RBI controls credit. So as we've learned in macroeconomic class, quantitative easing and qualitative easing. So to start with, quantitative easing is a way of controlling credit in an economy where not one sector is focused, but entire economy's credit is controlled. And there are various ways in which RBI does it. It does it by bank rate or discount rate policy. It does by open market operations. It does by statutory liquidity requirements, or through various cash reserves. There are different ways in which quantitative easing is done. I would like to elaborate on open market operations. So open market operations is, plain definition, the buying and selling of bonds in the market, and then this is how RBI RBI gets to make money and bring in liquidity in the market. So this is quantitative easing. So qualitative easing, on the other hand, is just it is laser focused on controlling credit in particular sector of the economy. This is done for various reasons. It is done to stabilize the prices of certain goods and services which are extremely price sensitive. It is done to stabilize the value of securities. It is done for a particular sector in an economy without it affecting the economy as a whole. It is done it is done for it's done for paying unfavorable balance of payments. So qualitative and quantitative easing. Now, talking about the non-banking financial crisis. So this started in 2018 when the NBFCs, the non-banking financial institutes, they borrowed short-term loans, from bank and mutual funds, while these are short-term goals for 90 days, and then these were given to people, for longer-term projects like infrastructure, real estate, and so what happened was that like the bearers were not able to pay these loans back, and then it's like trillions of rupees were locked suddenly, like there's a freeze in the of that much money in the economy. So what were the effects on the Indian economy? So because of the NBFC crisis, there were these thousands upon thousand projects which were just standing blank in the economy. So as per statistics, banks had to face around 3.5 lakh crores. That was the amount of money that is frozen in the economy. So, and these were the projects in real estate, in constructions, in infrastructure, and so the very bad thing about what happened was that they were not able, amidst this crisis, they were not able to borrow money for the completion of project, nor were they able to sell the project. So this was we're talking about 3.5 lakh crore money in the Indian economy, just stagnant in one corner. Just people, the owners of these projects rather, they are in limbo, So this obviously would have very adverse effect on the economy. So what happened was that subsequently the NBFC segment, the consumption fell, and then it started affecting the macroeconomic growth of the country, since there was no liquidity, since they didn't have any liquidity to access to. So I would like to bring one infographic that I found from statistics.times.com, and over here you can see here, sir, that see, the NBFC crisis started in 2018 in the it started around September, and then in Q4 you can see where the blue arrow is, the growth of Indian economy is 5.83%, and if you come if you come to 2019, please look at the red arrow, sir. Excuse me. The GDP has fallen, has drastically fallen 5.01%, and this was the first time that after in a very long period in India's history that GDP had fallen so much. We did not have negative growth, we were not in recession, but then the GDP was falling. The GDP had fallen rather. So in order to revive the economy, what can be done? Is credit probably controlling credit is one part of it. I'm not saying that it is you just control credit and boom, you get a very good economy. That is very naive, obviously, to say. But there are a lot of things which India can do. One is twerking the interest rate, but then has it proved is it decreasing interest rate, has it is it enough? We don't know yet. So what is RBI doing is it is attempting to increase the liquidity so that so that these NBFCs can invest more in the shadow banks. So there is one lesson that we can take from the 2008 financial crisis from the United States. Probably this is just one situation that in the RBI can do quantitative easing just like the Federal Reserve. How did the monetary policy look for Federal Reserve back in the days? So the Federal Reserve, it brought back stressed assets and securities from bank, and thereby because of these assets money was created, and this was done so that liquidity could increase, and this will clean up the balance sheet of the banks, and the banks would be able to, they can lend more. So, like, monetary policy, quantitative easing, controlling credit is one aspect of reviving or revamping or getting Indian economy started. But what it really also needs, side by side, is the reforms in fiscal policy. We have we have so much of poverty and unemployment in the country. So monetary policy alone cannot revive the Indian economy. There has to be structural changes that need to be done in the Federal Reserve. What am I saying? Sorry. In the fiscal, there needs to be some fiscal reforms, and yeah. So that's it. So monetary policy along with fiscal reforms are the need of the hour. RBI is cutting repo rates. Yes, that is one thing that RBI can do, so that the decreased interest rate will reduce the cost of loan, and that will eventually increase and stimulate the economy. That will even increase the consumption. But then again, I've made this video in a very sensitive time. I've made this video during the time of COVID-19, and it is very uncertain. We are in a lockdown right now, but we're in an uncertain time, and we do not know where the future will go. But that's it. Okay, sir. Thank you so much. Bye bye.